Good Saturday afternoon, everyone. I think it's the end of January, and it is January 30th. So, welcome. I wasn't planning on doing a video this week as I'm still playing catch up to end the year and the month, and now we have a new month that literally just ended yesterday, trading wise. But it was an interesting week, and I thought after getting so many questions on what's going on with GameStop, as some of you may have read, I did a blog on it. I didn't even mean to do a blog on it. I was starting to write something else on the blog, and I started mentioning GameStop. Before I knew it, I was at the end of the blog, and most of the blog was full of GameStop. So it is winter finally came to the Northeast. If you're living in New England, you know it's finally chilly outside with a storm coming here on Monday. It's winter in New England. This is what happens. It gets cold. Next weekend it's going to be 40 degrees. So you know what Mark Twain said, if you don't like the weather, wait a minute, it will change, just like what's going on in the markets. So let me start off and say I hope everyone is doing well. You're staying safe, you're staying sane, and you're staying warm. If you're in the South, you clearly don't have the problem you have in the Northeast. So on my front, I am excited. If you follow me on Twitter, you may have seen that I am finally walking without my crutches and walker and knee scooter and boot. I am in 2 old sneakers right now and very happy about that. So as February begins, I am walking on the ground and way ahead of schedule. So although I don't think my ski season is going to happen because I'm probably grounded until May, at least I've got sneakers on. I'm walking well ahead of schedule. So I'm very happy about that. Let's see. Let's start with, so the markets we're going to talk about today, certainly GameStop, and then I'll finish up with the January barometer. Before I do, I met an interesting fellow the other day online. We had a Zoom call, and we had a phone call and a Zoom call. And what I found interesting was, which is common sense, we all say this in theory, but in practice, the gentleman was telling me a tragic story about his teenage son passing away unexpectedly and without any reason, which as a parent, you can't even fathom the grief of having any child of yours pass, but certainly not a young one. And it certainly puts things in perspective that, my job is to care for my clients, watch their finances, prudently manage their funds to the best of my ability. But in the end, I mean, really, if you don't have health in your family, no money in the world can bring back someone's loss. So it's certainly a sobering reminder of, how fragile life is and how little money really matters at the end. He shared with me that some comment that Steve Jobs made as at the end of his life. And I tell my kids all the time, my kids are younger, so they see nice things, they want nice things, and that's good, something good to strive for. But in the end, I don't know anybody who's ever been on their deathbed. They're, a day or an hour before death, they're looking up, hopefully they believe in heaven, they're going that way and not that way. Nobody ever says, as you're passing, gosh, I wish I made an extra $100, $1,000, $1 million, and I wish I worked that extra hour in the office. Nobody does that. They always say, I wish I spent more time with my family. So it certainly puts things in perspective. And as a parent of 3 kids, you can certainly feel for anyone who has lost a child. So that certainly was the impact that it had on me this week. So I thought I'd share it, whether clearly you care or not, but it certainly was sobering. So let's go on to the markets. As you know, we came into 2021, and I've been mentioning this in every blog since, early November, mid-November. We now have and continue to have an epic amount of greed and euphoria. And maybe you're getting sick and tired of hearing about it and you don't think it's a big deal, but there is more greed and euphoria right now than there was 11 months ago when the stock market peaked. And then the COVID crash took a third of the value off of it. There's more greed and euphoria now than there was in January of 2018. We saw a 13% decline then. In 2017, greed and euphoria, markets only went down 4 to 6%. That was surprising. People got so negative so quickly. We went from greed and euphoria to fear and despondency pretty quickly. And that's what fixes this. You go from greed and euphoria either back to neutral or towards the fear and despondency side. And there's certainly more greed and euphoria today than we saw in Q2 of 2011. The only time in my life where it was worse was the dot-com bubble. And I will say this, I don't think we will ever see that kind of investor behavior again. So this is dot-com bubble 2.0, but it's not a carbon copy of the dot-com bubble for a variety of reasons, which maybe I'll do a separate video on. It doesn't have to be. Every market peak doesn't have to look like the dot-com bubble, because for sure the 2007 peak did not. There was not epic greed and euphoria. There may have been in housing, but it wasn't in stocks. So we continue to have that. A tiny bit was shaved off. Look, the market's down 2 to 4%. Is it a big deal? Oh my gosh. I listened to some, well, it's not some person, it's a woman I call the Nibbler on TV. She's a regular on CNBC, and she's perfect to go opposite. So after a 2% decline, she was doing the phew. Wow, I'm glad we had a little rally on Wednesday. I mean, you're off 2% from an all-time high. The market's gone straight up since October 30th. And you're comforted that we rallied on Wednesday after a 2% decline? I mean, give me a break. So that's where we are. And I imagine that as we begin February, which in a post-election year, February is typically not a good month. Doesn't mean we're going to have a COVID crash and lose a third of our value, but February typically has some headwinds to it. And I fully expect the stock market to find a low at some point in February. Could it be on February 1? Yes. Could it be on February 28? Yes. I'll tell you when I think we're there, but I can't tell you on January 30th that when I think the low is. I frankly, honestly, I don't know. We'll see what the data says and the indicators say. I would love if investors throw in the towel and get super negative really quickly. I don't sense that's going to happen, but it could. So let's go on to what happened this week. If you don't know, which almost everyone does, it's on the national news now. Stocks like Gamestop and AMC Theaters, and then Nokia, and even American Airlines, and some of the stocks that we own went vertical up, and then they collapsed, and then went vertical again. And you're seeing a repeat. In 1999, you had different kinds of message boards. Certainly, Yahoo was a popular message board. Today, it's Reddit, Redditt. Now, I'll be honest, I don't think I've ever been on the Reddit message board. It's not my thing. I don't really care. I don't have interest in that, but I understand what's going on. And there's a separate group, Wall Street Bets, blah, 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 blah. Shorting stocks is the exact opposite of buying stocks. When you own a stock, you're playing for it to go up. When you sell short a stock, you're playing for the stock to go down. Plain and simple. So it's public knowledge, public information, how much of a stock's outstanding shares are shorted. GameStop had over 100% of their publicly outstanding shares or their float shorted, meaning there was an awful lot of people betting that GameStop was going to go down. Just like AMC Theaters, Nokia, American Airlines, and list goes on and on and on and on. In the 90s, there was a newsletter, and I can't remember the name of it, but it was a rotund, Rubenesque, jolly guy who published, I could picture him with his beard and the glasses, and his name begins with a D, his last name. But he published a list of the most shorted stocks on the market. And I think it was called the Short Buster. And sometimes groups would get hold of those lists. And there you could subscribe. And they would try to run in the shorts, meaning they would try to legally, I would say, in the gray area, manipulate stocks. Because if a lot of people are short a stock, if you own a stock at 100, it goes to zero, you lose 100%. If you short a stock at 100 and it goes to 200, you lose 100%. But it could go to 300, 400, and to 1,000. And that's what happened with GameStop. GameStop was a $2 and change stock 11 months ago. I'm even going to pull it up on my chart to show you. And it was in the newsletter. GameStop was $2 and change last March. I don't want to show you all the crazy increase in it. Let's share the screen. So here's GameStop. It was in April, it was $2 and change. And then it went to literally $500. But it didn't do it all at once. And you can see how it traded during the year. It went from 2, and by the end of the year, it was roughly $20. 2 to 20 is a monster run. Major hedge funds apparently started to short the stock during this run from 6 to 20. Perfectly legal, hedge funds buy, they sell, they short. And then something weird, really weird began to happen. The stock caught this insane run, apparently from a group of traders on Reddit. Now, we're all saying it was individual mom and pop, because it sounds nice that, David against Goliath and they're slaying the dragon, blah, mixing metaphors, blah, 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 blah. I sensed it's probably a little more complex, and that perhaps there were some big players who helped feed this fire to move GameStop higher. I don't think it was Mary Smith and John Jones with their 100 shares, because all of a sudden, if you look on the chart, we go from $20 to 40, almost 40 in a day. And yes, I understand that what Wall Street Bets and the Reddit boards do, but there had to be big money behind running in these hedge funds like Melvin Capital. So now the hedge funds are really screwed. You got a stock that's now doubled again. And my argument at that time was, how could any fund, hedge fund, where you pay an exorbitant amount of money to, not have a risk management plan? You can't just let the stock go from 20 to 40 or from 2 to 10 or whatever the number is without having a plan to reduce your losses. Well, I'm guessing they didn't stop there. They just piled on and said, you know what? No way is this real from 2 to 20 or from 20 to 40. Let's go further. So before you know it, a week later, you had, boom, from 40 to almost 80. And now you've got hedge funds on the verge of blowing up. Melvin Capital was the public one. And I'm sure they went to their funders and said, hey, we need a lifeline to survive, blah, 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 blah. And before you know it, we have a stock that goes from essentially 20 to 160 in 3 weeks. But it didn't stop there. No, folks. We go from 20 to 380 and then to almost 500. So I don't want to say there's nothing wrong with that, but this happened daily during the dot-com bubble. It's crazy. It's insane. But the regulators like the SEC, their job isn't to stop trading. Their job is to make sure the markets are fair and there's an orderly flow. So as long as the stock was functioning in an orderly fashion, that's okay. We don't want regulators to have a too heavy hand. Now, there are collars on trading. So when a stock's volatility gets too great, like an alligator's jaws opening up, the stock will be halted. It stops trading across the exchanges. That's okay. I may not love it, but that's okay because it's fair for all parties. Now, the real outrage happened when we know platforms like Robinhood and TD Ameritrade and Interactive Brokers decided that for the good of, I'm saying in quotes, for the good of their client individual investors, they're going to stop you from hurting yourselves by not letting you buy new shares of GameStop and AMC and whatever, Nokia and whatever else. On the surface, you'd say, okay, maybe they're altruistic. Problem is, Robinhood's real customers are not you who opened an account for 1,000, 100,000, 10,000, whatever. Robinhood's customer, because you trade for free, they don't make any money off of you. They make their money by selling your orders to companies like Citadel, a behemoth, one of the biggest hedge funds on earth, who has multiple businesses, and they've made a fortune investing in all different kinds of things in the market. Citadel is one of, I think it is the largest high frequency trading firm in the world. So Robinhood sells their order flow to Citadel. And that's where we don't know what truly happened. We don't know why Interactive Brokers and Robinhood did what they did by limiting you of buying more GameStop shares. I have no facts at all, but you can certainly speculate that perhaps a hedge fund who is in trouble may have called Citadel, or Citadel may have been invested in this hedge fund, and the hedge fund called their investor and said, hey, we got a problem. We're going to blow up. Can you help? And perhaps another firm may have called Robinhood and said, hey, you got to give us a day to help. I don't know this. It's pure speculation, but perhaps that could have happened, which is why, when I saw Tom Petterfeet from the founder and CEO of Interactive Brokers on TV, he was essentially admitting to things that were, I would say, unethical. All this is legal because we all sign brokerage applications giving brokerage firms the right to basically do whatever they want with our shares and with the rules. So it's not illegal, but with all the, when it makes the NBC Evening News and it's not on CNBC and Yahoo and Fox Business, now the politicians all weigh in and opine because now it becomes populist. So you get people like Lizzie Warren and Cortez and Ted Cruz. You get a problem when people on the far left and the far right are all demonizing a certain individual, company, or cause. You got a big problem. So clearly there are going to be hearings in the House and hearings in the Senate, and people are going to want to champion the little guy's cause, which is great. So I only want to know who bailed out whom, and you got to follow the trail of the money. So in GameStop, you can't, no one's ever going to know. I don't care what they tell you. We're all speculating how GameStop went from 20 to 500 in a couple of weeks. No one's going to know for sure. We only know that it happened. And the markets function okay. You're going to argue with me, but the markets function okay, allowing GameStop to do that. That's still an orderly market. What we don't want is an unlevel playing field. Shame on Robinhood on one day for letting them do whatever they wanted, and then the next day saying, for the good of you, we're going to protect you, and you're only going to be allowed to trade in other stocks. That's not right. So what do I think people keep? What do you think? What do you think? I think this is going to end poorly for GameStop and probably the other stocks. Does it end on Monday? I don't know. But I think it ends sooner than later because of the public awareness of it. This could have gone on longer, but once the non-financial media got involved and Congress got involved and it became a national thing, I got people sending me texts and emails and Facebook messages about their kids owning GameStop and the other stocks. So and even my 15-year-old son every day for the last week's been analyzing, GameStop and other stocks like it. So if it filters down to that broad a level, in my mind anyway, for my 32 years in business, you're at the end of the mania, not the beginning. So I think it's going to end poorly. I think it's going to end poorly in February. Is this something that I would trade? I wouldn't trade. Would I say absolutely? I'd have a tough time committing client funds to stuff like this. It doesn't fall in, my area of expertise or probably my comfort level, because it's not that I don't think we can make money. I always feel confident that I can make money. But if I'm wrong and my clients lose, what do I have to fall back on? I mean, who in their right mind as a fiduciary, that's what we are. We have to do what's prudent. We have to do right by our clients. Who in the right mind would purely speculate with anything more than a tiny piece of GameStop or Nokia or any other ones? So I'd have a very tough time justifying it when I'm wrong. And the likelihood is, because we're so late in the game, I would be wrong. Now, if I bought it at 2 or 5 or 10, I'm feeding the ducks. I'm getting rid of that on the way up. I would never have held it to even 40 if I bought it at 2 or 5 or 10. That's not my personality. It's not how I act. I believe in, as things go in your direction, you keep pulling off and you harvest your acorns, and you got to play some defense. Life is not about always putting the pedal to the metal. You've got to play some defense. But now I'm getting into a different philosophical discussion than the topic at hand. So that's what's going on there. I'm not going to say for sure this is nefarious, but something smells a little rotten. And I think it's on twofold. I don't think everyone on Reddit is this mom and pop investor. I would feel that there are people masquerading, big money masquerading as mom and pop to start the snowball, keep the snowball moving higher to run in these other hedge funds. And I also think that those platforms, shame on them. I mean, I don't fault the hedge funds that blew up. They should have had a risk management plan, but they're welcome to short the stock. I mean, and the last thing is, people keep asking me, shouldn't short selling be outlawed? No. It is such an absolutely vital and necessary function in the market. Short selling allows companies to hedge. So if you're an options provider, you have to hedge your exposure. You need short selling for that. Hedge fund short selling gives you better liquidity, more money in the stock, tighter spreads, which I'm not going to get into, and then I don't want to get wonky on you guys, but short selling adds to liquidity in the market, and it helps with price discovery. We don't want a one-way market. A one-way market becomes illiquid and prone to an absolute and utter calamity. We want more investors, traders. We want more people in this. So you want short sellers. And for those who say that the government only cares about, sticking it to the little guy, or the SEC does, that's not true. Because in 2008, remember, and you probably won't, they were trying to ban short selling of bank stocks, as if somehow they were going to prevent bank stocks from collapsing. And we know that big money hedge funds, institutions are the primary short sellers. So back then they stuck it to the hedge funds and institutions. Eventually water find its own level, no matter what you do. So will GameStop be a $500 stock? Not in my opinion, it won't. Will it be a $100 stock? Not in my opinion, it won't. Will it be a $50 stock? Not in my opinion, it won't. Could it be there temporarily? Of course. Look at what Yahoo did in the dot-com bubble. I always think about that. And other stocks that went just melted up the side of the page, and they had no earnings, and they had no revenue, some of them. So I know this is going on a long time, but I definitely wanted, this is such a widespread topic now. What's going on? It's the GameStop debacle in the markets. So you should kind of get an idea. So I don't want to just bitch and moan I love giving solutions. So any board I've ever sat on, I'm fine you complain, just give me a solution. So I'll give you a solution. When institutions own stocks, when they get above 5%, they must disclose publicly in a filing how much stock they own. It's not the case on the short side. So why shouldn't it be a level playing field? If an institution shorts 5% of the stock or 10%, whatever the case, let them disclose it. Let's get more information flowing here. But I heard, some of these crazy politicians, Lizzie Warren and Ro Khanna, they're talking about the way to solve this is by putting a tax on short selling. There's a lot of dumb ideas in Congress from the left and the right. Taxing short selling is ignorantly absurd. We don't want to do that. We want more people. We want more volume. You don't want less. And that's how you create an unbalanced market, by putting certain parts of the population out of it. You need a free-flowing market that works for buyers and sellers. This is not about rich against poor. No matter how people want to frame this, this is not rich against poor, big money, small money. You need a market that works. The infrastructure functions well. Anybody can buy and sell and get the best execution with the best price discovery. That's what markets are all about. So, long video. Again, I apologize. You know, sometimes I get carried away. If you like the video, please give me a thumbs up on YouTube. I am going to be back to you soon with another video on some financial planning with IRAs coming up, as well as the January just ended. I'll leave you with this. The month of January closed down. There's an old adage made popular by Yale Hirsch, the Stock Traders Almanac, regarding a down January, what that means for the rest of the year. I am going to try to do another video on that this week, and I promise you it'll be shorter. So thank you very much for listening. Enjoy, whenever you watch this, I'm going to enjoy the rest of my Saturday. Go grab my Jersey Mike's Turkey Club sandwich that I got this morning, sit on the couch and continue to get fat from being so sedentary. But enjoy your day, stay safe, stay happy, stay warm, and I'll be back to you all soon. Thanks.